When a massive corporation signs a multi-million-dollar insurance policy to protect a global fleet of cargo ships or a downtown skyscraper, a fascinating economic engine springs to life. But have you ever stopped asking yourself, where does that money actually go? If that cargo ship sinks tomorrow, does a single insurance company write a massive check and call it a day? The truth is, if they did, the entire financial system would collapse under the weight of the next major disaster. In our last video, we introduced the concept of reinsurance, the invisible safety net that acts as insurance for insurance companies. But today, we are pulling back the curtain to show you exactly how the machinery moves. We are going to track the life cycle, the money, and the exact journey of a single insurance policy from the moment a premium is paid to the moment a catastrophic loss is shared globally. By the end of this video, you will understand exactly how billions of dollars in risk are sliced up, packaged, and distributed across the world without the public ever realizing it. If you are a graduate entering the industry, a finance professional looking for a technical edge, or an aspiring reinsurance accountant wanting to master how the ledger actually balances, stick around. Because the way the money splits will completely change how you view global risk. Now let us have a look at the stakeholder matrix. To see how a policy travels, we first need to meet the characters in our story. There are 4 primary stakeholders that form this global chain. Let's map them out using a real-world example. A major commercial shipping company looking to insure a container ship valued at $100 million. Stakeholder number 1, the insured, the client. This is our shipping company. They own the asset and need financial protection against a catastrophic loss at sea. Stakeholder number 2, the retail insurance broker. A common misconception is that big corporations just call up a standard insurance company. They don't. They hire a specialized broker. This broker's job is to evaluate the client's risk, structure the policy, and shop it around the commercial insurance market to find the best coverage terms. Stakeholder number 3, the primary insurer, the cedent. This is the frontline insurance company that actually issues the policy paper to the client and collects the initial premium. But remember our core pillars from video 1? This insurer cannot safely keep all this risk on their own balance sheet. Which brings us to stakeholder number 4, the reinsurance broker and the reinsurers. Just as the client used a broker, the primary insurer now uses a reinsurance broker to access the elite global reinsurance market. These reinsurers are financial giants sitting in hubs like Munich, Zurich, London, and Singapore, ready to backstop the primary insurer. Now, here's the hidden trigger most people miss. The client might only ever interact with their retail broker and the primary insurer. They may have absolutely no idea that their risk is immediately being spun off into a global web of reinsurance companies. Why do we do this? Let's look at exactly how the money is sliced up by a practical illustration of premium split. Let's talk numbers. Our shipping company pays a $1 million gross premium to the primary insurer to protect that $100 million cargo ship for 1 year. How does that $1 million get carved up? Let's look at a standard quota share proportional reinsurance agreement where the primary insurer decides to retain only 20% of the risk and cede 80% to the reinsurance market. Now we will look at how to navigate through this with the following steps. Step 1, which is the brokerage deductions. First, the retail broker takes their cut for placing the business, let's say 5%. That's $50,000 gone off the top. The remaining $950,000 is the net premium received by the primary insurer. Step 2, the retention slice. The primary insurer keeps their 20% share of the net premium, which equals $190,000. In exchange, they are legally on the hook for 20% of any loss that happens to that ship. Step 3, ceding to the reinsurers. The remaining 80%, which is $760,000, is passed along to the global reinsurers. But here's a massive concept you need to know for reinsurance accounting, the ceding commission. Reinsurers don't get this $760,000 for free. Because the primary insurer did all the heavy lifting, marketing, underwriting, and administration, the reinsurers pay a ceding commission, say 20%, back to the primary insurer to cover their operational costs and generate a profit margin. So, out of that $760,000, the reinsurers send $152,000 back to the primary insurer, leaving the reinsurers with a net premium of $608,000. Look at what just happened on the ledger. The primary insurer has successfully offloaded 80% of a massive $100 million liability, kept a portion of the premium, and collected a guaranteed commission from the reinsurers. Before we move on to how a devastating loss gets paid out from this split, if you find this breakdown valuable, take a quick second to hit the subscribe button and turn on notifications. We are building the ultimate hub for reinsurance mastery, and you won't want to miss our upcoming deep dives into facultative versus treaty mechanics. Just how premium is shared, losses also have a similar treatment. Now, let's test the engine. The unthinkable happens. The container ship hits a reef during a severe storm, the hull breaches, and the vessel sinks. It is a total loss. A $100 million claim is filed. How does the money flow backward up the chain to cover this catastrophe? It is the exact inverse journey of the premium. There are basically three phases. Phase 1 is the frontline payout. Legally, the shipping company's contract is with the primary insurer. The client collects the full $100 million from them. To the outside world, the primary insurer just saved the day. But behind the scenes, their accounting and claims departments are executing a massive capital recall. The Phase 2 is the proportional recovery. Because this was a 20%, 80% quota share split, the primary insurer absorbs their contractual agreed retention of 20%, which means they pay $20 million out of their own capital reserves. The primary insurer then formally triggers their reinsurance treaties to recover the remaining 80%. The global dispersal is the third phase. The reinsurers step in and wire $80 million to the primary insurer. But it gets even more elegant. That $80 million loss is rarely held by just one reinsurer. The reinsurance broker likely spread the 80% across 5 or 10 different global reinsurance firms. Reinsurer A in Munich pays $20 million. Reinsurer B in London pays $15 million. Reinsurer C in Bermuda pays $10 million. A devastating shock that would have completely vaporized a local insurance company has been diluted into minor, easily absorbable line items on balance sheets spread clear across the globe. This is the absolute essence of global risk diversification. We would end this session by highlighting some of the key takeaways. Every single day, thousands of these premium and loss journeys occur across the global financial markets. From aviation and cybersecurity to natural catastrophe cover, reinsurance accounting is the discipline that ensures these massive balances tie out flawlessly, keeping the world solvent when the worst occurs. Now that you know how a single policy travels and how the stakeholders interact, you are ready for the next structural leap, understanding the difference between insuring a single specific risk versus insuring an entire portfolio of business. In our next video, we are diving deep into facultative versus treaty reinsurance, the two fundamental ways these contracts are structured in the real world. I want to hear from you now. If you are working in insurance or studying finance, which part of the premium and loss split surprised you the most? Drop your comments, feedback, or technical questions down below. I read and answer every single one. Don't forget to like this video if it brought you clarity today, share it with a colleague, and hit subscribe to join us here at the Reinsurance Academy. Let's master global risk together. See you in the next session.